All right, good morning, and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner, and we have a special guest with us today, and that is Matt Ewald. I should have pronounced or asked about the pronunciation of your name in advance. Is that correct?
You got it spot on.
Awesome. Awesome. I love when that happens. So Matt is joining us today. He works with Advisors Excel, and he is here to really help us talk through a particular question that might potentially be on your mind. So as you are thinking about wealth transfer from generation one, you, to generation two, you might have across your radar some conversations and questions about what type of life insurance might be an advantageous or most advantageous product to help you do that. And so we've had a lot of conversations around whole life insurance, but there are certainly other products in the world, in the universe of life insurance, that can also have advantages. And so today we're talking about really guaranteed universal life. So guaranteed universal life, a different product than most universal life products, and also different from the IULs and the VULs and the variable life. So today, what we're going to be doing is really talking through what types of reasons you might be considering guaranteed universal life, what job it does, what it doesn't do well, and really just unpacking for you what this means in the world of estate planning and wealth transfer and doing that exceptionally well, especially in the context of high net worth families that are looking to transfer wealth without a lot of loss and have the right strategy surrounding that. So, Matt, thank you for joining us today. I'm going to share a little bit about you in just a moment, but thank you first for joining us on this conversation.
Yeah, happy to be here and look forward to chatting through. And obviously, my background is all in the insurance space, so it'll be a fun chat with you guys today.
Awesome. So I do know that you are the vice president of life insurance at Advisors Excel and that you've been working for 15 years in this space. So that's no small feat and that's no small amount of experience, meaning that it is a lot of experience in this area. And so I know that you're working in the area of high net worth families. You also are supporting top tier agents across the country, or advisors maybe would be a better word to use for those that are really helping clients and the general public to understand their
Mhm.
life insurance decision making. So, Matt, would you share anything more about your background, just as that pertains to the conversation here before we get started?
Yeah, so maybe I'll touch on what Advisors Excel or who Advisors Excel is, and kind of go into where I serve. So Advisors Excel is what we would call a financial marketing organization, and sometimes referred to as an FMO. And essentially, what an FMO is we're basically a distribution partner for independent financial advisors around the country. Our advisors focus on the age 55 plus, so kind of the pre-retiree and retiree market. And then we have an annuity division, a life insurance division, an RIA, and then a Medicare division. So really, the goal of all of our advisors is to ultimately get their clients to and through retirement. And we do a lot of things as far as, rather than just being a distribution partner, we want to be really a business partner for our advisors. And our vision is ultimately, how do we help good financial advisors become great business owners so they can help people enjoy amazing retirements. So really, there's a lot of things that we do that's not even just in the financial advising space, a lot in the marketing space, making sure that advisors are out there, whether they're doing radio, TV, a lot of things on the creative side. So really kind of a one-stop shop in our space. And the company, I think when I started in 2010, we had about 45, 50 employees, and now we're up to 1,000. So the explosion's been great. It's been fun getting to work with offices like Bruce and everyone around him all around the country. And then specifically, I serve in the life insurance space. So when we're working with our advisors and they're working with their clients, helping them build out financial plans, estate planning strategies, you name it, I specialize in the life insurance space. So today we're going to spend a lot of time talking about guaranteed universal life, or just some sort of life insurance contract with a no lapse guarantee rider. But we work with a little bit of everything. So we've kind of seen the good, the bad, the ugly over the years. And it's been fun. And 15 years has gone by fast. So I guess time flies when you're having fun.
That's awesome. I love that, Matt. And Bruce, any comment here? Specifically, I know that you know Matt and you've met him before. You work through Advisors Excel, and then just your thoughts on this context of this conversation as we're jumping in.
Yes. So First of all, I'd like to say that I've been around the insurance industry since the late 80s, and I've had other businesses and wealth businesses and so on and so forth. And with without a doubt, this is not hyperbole whatsoever. Without a doubt, Advisors Excel is the best organization that we've ever actually partnered with um, in any aspect of our financial services. They are, without a doubt, the cream of the crop when it comes to a partnership um, with whatever they do. Everything they do, they actually do at the utmost competency, and not only just the competency, but with the also where it is true a true partnership where you feel like they're not working for us and we're not working for them. It's just an unbelievable thing, and I've dealt with a lot of different marketing organizations over my career, and they all talk a good game. They all talk about how great they are, so on and so forth, and they're only in it for one thing, and that is to see how much money they can make. Advisors Excel's owners uh, share what you and I share, Rachel, and what we talk about all the time with our clients is that when you bring great value, the compensation will follow. And that's what they've done over and over and over again. Matt and his team is frankly so responsive. Um, we recently were trying to work on a very difficult case, and it's still ongoing. And yet, whatever time they've given us, it's been wonderful. Even though things haven't been moving forward with this particular case, and he and his team are just there for us every single step of the way. So I know we've done a podcast on how to get into the business and how these uh, marketing organizations a lot of times will actually hinder your progress, but Advisors Excel does nothing but be like a rocket ship to help you take off in your. So I just wanted to give that little plug from myself and not from the marketing organization because they all talk a good game, but they actually live it.
That's awesome. That's awesome. And Bruce, it's been really interesting that we've had a lot of conversations lately on the podcast around high net worth life insurance strategies. And we have a lot of people who are asking questions about the estate planning side, the life insurance strategy, specifically in a high net worth or ultra high net worth context. And that brings us to different questions than just the infinite banking context that we typically are addressing. So, Bruce, do you want to just unpack that a little bit before we dive into talking about differences of products?
Yeah, well, excuse me. The current case that Matt and I and his team are working on is a very high net worth person that is in the $60 million ranges and realizes he will have an estate planning problem as far as inherited taxes or estate taxes, and then his daughter and his son are already very high net worth people. They aren't quite over the exemption level yet, but any money that flows down to them, they will be easily over the exemption level yet in the future. And that's if the exemption level stays at where it is. I'm of the thoughts that we are going to reduce the exemption level here in the United States from the current almost $14 million per person to what I would think would be under $10 million. So a lot of people that are listening to this call right now may actually say to themselves, well, I'm never going to be over that exemption limit. But I want to remind everybody that just the George Bush administration, a Republican administration, the exemption level was only $1 million, and then it went to 5 million, and then it went to the current, which is approximately close to $14 million. So if you're on this call and you think you're not going to be um, in that have that problem, then I really think you should evaluate because the government can change these exemption levels at any time. What we're really talking about today is twofold, I believe, is how to use life insurance to help you pay for your estate taxes. And then you can do it a couple different ways. You can actually do it where it actually goes into your estate, or you can actually do it outside of your estate. We're not going to actually talk about that today because that involves some trust. What we really want to focus on today is actually how the inner workings of guaranteed products, because everybody on this podcast is used to us talking about whole life. And the reason we love to have whole life is we're actually talking about it in a way that you can use it for banking purposes. And now we're not going to talk about insurance for banking purposes. We might get into a little bit of why it's not a great tool, universal life, to use for that. But mainly, we just want to talk about the guarantees. And actually, Rachel, some of the index universal lives you can actually take and put some riders on it that are very much in the guaranteed side of it. So Matt will hit on that. So Matt, I think right now, if you would like to just kind of give a framework to our audience about the differences that you can see from the non-forfeiture on universal life compared to guaranteed universal life. I think that would be a good starting point.
Yeah, so I think first and foremost, obviously, I know on the podcast you guys have spent a lot of whole time in the whole life arena talking about kind of the privatized banking and really utilizing an insurance policy, specifically whole life, as a wealth accumulation tool or wealth savings tool. A lot of the things that we're going to go through today and a lot of the planning opportunities, it's kind of the exact opposite. Rather than trying to get as much capital into a contract and let that accumulate, and then obviously clients can deploy it or take distributions, loans to do other things. We're really doing the exact opposite here, kind of the 180-degree opposite. We're trying to get the most bang for our buck today and get as much life insurance coverage as we can for as little premium as possible. So hence the guaranteed universal life. It's really pay think of it as I like to use the phrase permanent term contract. I want the cheapest premium for the biggest death benefit, but I don't want a term contract, obviously, because those can expire and all the other reasons you wouldn't want term for it. So the word permanent is ultimately, do I want to have this policy guaranteed to age 95, 100, 105, however long an advisor and a client might want to get them to go. And then within, I know we've used or thrown the term out, guaranteed universal life, a couple times today. GUL is what the acronym our industry uses quite a bit. There's probably a little bit of a change in the industry, and I think a lot of the products that carriers are developing nowadays actually are what I'd say from an acronym is GIUL, so Guaranteed Index Universal Life. So it's the same thing. It just the product sits on a IUL chassis versus a fixed rate chassis or universal life chassis. So from what we want the product to do, which is cheapest premium, biggest bang for our buck on the death benefit. Mechanically, the product's going to work the exact same and accomplish those results. But if the policy sits on an IUL chassis, it just means that there may be some ability for the inner cash accumulation behind the scenes to accumulate if there is performance there. But ultimately, if there's no performance, not a big deal.
So I think what would be really helpful at this point, I mean, there's so many angles and parts of this, but could you differentiate the difference between a typical IUL and a guaranteed IUL? What's the mechanism that's making it guaranteed? Because there can be challenges because of the lack of guarantees in IULs.
Mm-hmm.
So can you elaborate on that?
Yeah, and Bruce and I were chatting about this, and we talked about it over the course of our partnership working together. The industry uses the term IUL in kind of this very generic statement. It's kind of like in your guys' whole life world where you're using a lot for the privatized banking. That's not the only way that a whole life product can be used. IUL is the same way. It's a term and an acronym for a product type. And there's underneath the hood, just like in whole life, underneath the whole life hood, there's a lot of different products out there, and there's a lot of different ways those things can be designed and utilized. So when we use the term IUL, I think first and foremost, the industry typically thinks of as a cash accumulation type product, kind of like you'd use for the whole life world, where you're trying to stuff as much capital into a policy over the first 5, 7, 10 years of that policy. So when we're using policies in that arena with different products and different carriers, it's two ends of the spectrum products that we're using for what we're talking about today, which is kind of more of the estate planning space. So in the IUL space that we're using for cash accumulation, again, we're building those products out to get as much capital in as quickly as we can and build that life insurance as kind of an asset class vehicle. And then in this world for conversation today, where we're using more of the death benefit oriented contracts, typically these products will have some sort of a no lapse guarantee rider, policy protection rider, basically a rider on there that says, hey, if you client pay this premium for 5 years, 10 years, 20 years, for a lifetime, however we design the product with the advisor, then what the insurance company will contractually guarantee is that death benefit we're buying is going to stay here, will always be there as long as you're paying that premium. So having that rider on there is really what kind of gets the product to work how we want it to, which is, the guarantee side of it. Without that rider, you're sitting in kind of that IUL space where it's just kind of like you're going to really be dependent upon how the market does, the performance you get, what the carrier does for cap rates, renewal rates, and all the other things that there's the non-guaranteed aspect of an IUL. You still have that component with these products, but it's the no lapse guarantee that kind of plays they call it the trump card, where regardless of what happens with cap rates, par rates, index performance, that's kind of just under the hood. Doesn't really matter. If those things work a little bit and we get good performance over time, all that's going to do is provide the client some flexibility. So if, hey, 10, 15, 20 years down the road, our needs, wants, plans change, we may have some flexibility. We may not, we don't know, but we're not getting in, really, you're not getting into these contracts for banking on that flexibility. You're really getting in for the purpose that we're trying to serve, which is in the estate planning, wealth transfer, legacy planning space, where we just want the cheapest premium for the biggest EB to help cover estate taxes, income taxes on a lot of families retiring now, the baby boomers. A lot of them are retiring with 75, 85, 90% of their assets, investable assets in retirement, are sitting in some sort of qualified account. And so when we have the higher net worth families that aren't going to need every dollar they have to retire, ultimately they're going to be passing wealth on. Whether they have an estate tax problem or not, there's going to be wealth that's transferring. And there's no better vehicle to transfer wealth, in my opinion, than an insurance policy, obviously, because the tax features and things like that. So I think that answered your question. Just about really, it's the rider that makes it work and accomplish what we want. But again, two completely different product types that are all within the IUL umbrella.
I think what really is important to hear in this part of the conversation is that, just like, and I equate getting an estate plan to boat shopping, because in my book, Seven Generations Legacy, but this whole idea that you need to know what you're trying to accomplish before you can get the right product to do that job. And you're saying the same thing in the world of universal products, or IULs, and guaranteed, or IULs with a guaranteed no lapse guarantees, or the policy protections built in. And what you're saying is that you can't just grab the product and then expect it to do what you hope for it to do. You have to be very clear on the objective you're wanting to accomplish first. And if the goal is paying estate taxes so that estate taxes don't shave off part of the wealth that you want to pass down to your children and grandchildren, that's a very clear objective now that we have, where you're in a position of wanting to have the maximum death benefit to be able to pay those taxes with. And so I like that you're contrasting this two completely opposite ends of the spectrum that can be accomplished with a product. You need to know where you're approaching that product from.
Yep, exactly. And as we work with advisors, I spend pretty much all day, every day. My job is working with financial advisors around the country and helping build different designs out. And there's never, in the life insurance space, there's tons of carriers, tons of products, tons of product types. There's never a one size fits all strategy, not one product and one, whole life or IUL or term. It's never going to accomplish the same result. That's where, working with advisors and clients, understanding that there's lots of different things on the bookshelf that you can pull from, but then again, they all serve a slightly different purpose. And that's where, in my day, what I spend doing all day, every day is really working with the advisors to figure out, what are we trying to accomplish? What is our end goal? What's the purpose of this? Once I understand the purpose, the end goal, then I can kind of go to my Rolodex of product options that we have and then figure out what is the potential best solution for that avenue, what we're trying to accomplish for the client. It's never just take this one off the bookshelf and it's going to be this all day, every day, because, for one client, it may be a bit a fit, but for another client, you're trying to fit a square peg in a round hole and you're never going to get ultimately the best thing for the consumer.
So I have a couple technical questions, and then Bruce, you can take this wherever direction
Sure.
you're wanting as well. So I'm thinking of to add a rider on something, as we know within whole life insurance, if you're going to add on a waiver of premium rider to pay in a case of disability, or you're going to add on a term rider, there's going to be costs associated with that. So if you could kind of speak to the cost of adding on those guarantees or the riders that make the guarantees. I have thoughts on the idea of, is the term or is it still on a chassis of blended term? Is there rising costs within that inside of a policy? I don't know if that's a factor
Mhm.
inside of the IUL with the guaranteed rider. And then you mentioned a certain age as well. So it sounded like you were saying that you would determine what age you were going to pay until, or what age that was guaranteed until, which makes me think that probably the longer that you have the guarantees, the higher the cost would be for that rider. So I'm just thinking through some of those mechanics. Bruce, do you have a more succinct or better way of framing that? I'm sure that you have some of those same context questions that you're wanting to unpack as well.
I mean, I have some other things, but I think what you just said to Matt, just to talk through the fact that everything's a cost in insurance, and it's an actuarial cost, and the people that are putting these products together are always balancing the cost for benefits. And so, Matt, if you just could talk about, I think the number one thing what Rachel is talking about is when you work with a person to say we can have a non-lapse through age 85 or 90 or 100. How are those costs determined, and are those separate costs that can be line item out, and are those costs constant throughout it, or do they increase? And if they do increase, if it's guaranteed, that has to be figured into the cost of the premium.
Yeah. So the products, it's kind of hard to answer the question of an exact cost, because really what it boils down to is the actuaries when they build these products, it's kind of the costs are somewhat baked into the bread, if you will. So when we use these products, it's not like we're taking an IUL that we'd use for accumulation and we tack on this rider and make it work this way. There are some products and carriers that have that option out there, but majority of the time we're getting kind of a completely separate, call it, if we're in the IUL space, we're getting a kind of a completely different product that we'd use for this. So you could go into the policy, you could go into your statement and really break down line items and things like that. But for the most part, it's baked in. So the cost really kind of boils down to probably what Rachel made a question or a comment about. It's more about the duration of the guarantee that's going to dictate the cost and the premium that you're paying. Obviously, if you want a contract that's guaranteed to age 90 versus age 110, and I'm a 60-year-old male wanting $5 million of coverage, the age 110 is going to cost you more than what the age 90 guarantee is, just because you're guaranteeing it farther out. But you would be able to go to the ledger or get a policy cost and benefit report, and you can kind of see what you're paying for that no lapse guarantee rider. But I think the big thing to understand is that for these products, the way that they're designed, the way they're built, I don't ever want to say the costs do not matter because you have the guarantees, but in a roundabout way, that's all baked into the bread of the policy. So there are additional costs for the riders, but ultimately the cost would inhibit your cash accumulation and things like that. And as I mentioned earlier,
Right, yeah.
you're not getting into these products for the cash accumulation. You're getting them in for, I want that premium for that death benefit. And ultimately the costs are relevant, but somewhat irrelevant.
Okay, so like a follow-on question to that. So can you help me understand when you have a rider that and I'm not sure if I'm saying it correctly, the up until a certain
No
age, so the
lapse
duration, yeah, so the no
or
lapse
duration.
guarantee. So let's just say that that was to age 95 and the person with that policy lived to 100. What does that mean? Does that mean the premium could change at that point? What does that mean in terms of that no lapse guarantee. I'm not even sure if I'm saying the right word.
Yeah, no lapse guarantee rider. So your question was, hey, I'm gonna dial this illustration or this policy to have a age 95 guarantee, and then we get a client that is doing well, being healthy, and their life expectancy or they're living longer than maybe they originally anticipated. So you can definitely, it's not like age 95, everything's all said and done, policy's gone, policy's lapsed. You'll be able to extend the contract to age 97, age 100, age 105, whatever ultimately that client and that advisor wants to continue to get that policy to go to. In real life, if somebody's gonna build a contract to age 95 and they want to ultimately extend it farther out, you're always going to be better off if you're 85, 87, 90 years old and you're kind of getting to that point where, hey, I'm still doing really healthy and I got this policy that's only going to 95, you're going to be better off to extend that no lapse rider to age 100, when you're 85 years old versus when you're 95 years old and that policy is getting ready to lapse if you don't extend it. The earlier the better. And that's where I think it goes to, you guys probably have spent a lot of time in this. Insurance policy is no policy is good as it's sold as it is serviced, meaning I think our industry has never always done a very good job of servicing advisors and servicing their policies. This is not the old infomercial days, I forget the George Foreman grill, set it and forget it.
Yeah.
Life insurance is never in that world. It's always, it's got to be sold, serviced, and maintained. And no policy is going to be perform how you want it to be performing ultimately if you're not kind of looking at it every year or two or three, working with your advisor, making sure it's fitting the needs. Because look, time changes, needs change, wants change. What I would have wanted 10 years ago may not be what I need now. I may have had other economic, financial things that happened to me that differentiate what I originally bought this for. Things can change, and so ultimately flexibility is important, and also clients understanding that when I get into these contracts, that I have flexibility, and there are things that I can change if I want to. And the inverse thing can happen too. Is let's say somebody builds a policy where you have that age 95 guarantee, and all of a sudden I'm 80 years old now. I bought it when I'm 60, and I'm 80 years old now, and maybe I got a fair amount of health issues going on, and I know that getting to age 90 for me is a far cry. Maybe getting to age 85 is more reasonable. So you're also going to have the ability to say, hey, that age 95 guarantee, now let's go ahead and dial it back to age 87 or 88, which is probably still a little bit farther than where I'm likely going to live, but obviously you don't want to cut it short. So you have the ability to do the opposite. And then in real life, if you're paying X premium for Y death benefit, and you decide to cut that death benefit because of those health issues, then ultimately your out-of-pocket cost moving forward will be reduced.
I mean, Bruce, wasn't it Nelson Nash that said the only life insurance policy that's good is the one that's enforced when you die?
Yes, yes.
So
well,
there's that whole context here that you're saying there's a flexibility to make modifications to that ending point along the way, longer or shorter, right?
Yeah, you can make modifications. What Matt was saying is, if you go to age 90 and then you make the age 90, doesn't mean that it does mean like the no lapse is now no longer, but that doesn't mean it's going to lapse. So, and then even at that time period, you could put more money into the contract if necessary. That's the danger we always try to tell people is when you're using these ideas from these different internet gurus that say, you only have to fund this for 5 years and just forget it. That's really what they're talking about with the index universal life, and they're not servicing them because they don't know what's happening with the crediting, so on and so forth, and the fact that the mortality costs continue to increase. But you've said, oh, I can just forget this because I don't have to worry about it. With the guarantee products, they are figuring in those increased mortality risk to whatever age you want them to figure that into. And so even with increased mortality costs, they've already figured that in. The only thing that you have to do is make sure that you pay the premium that you said you were going to at the very beginning. And that's the other thing that the general public, forgets is, oh, well, I didn't pay it. I paid it for 3 years, and then the fourth year I didn't pay it, and I got back and I paid it the fifth year, but I also paid it late because Matt, yeah, I think you could talk about this too, is that at least there used to be, and I don't know about the guaranteed products, but there used to be in the UL products, if you didn't pay um, and you went into a grace period or even into a lapse, that doesn't mean that you couldn't get it back and forth, but then you lost the guarantees if you didn't pay in that different time period. Has there been anything changed in that area as far as timing of payments, or is it still by contract? In other words, if you're supposed to pay on March 1st, but you pay during the grace period, but you don't pay till April 15th, that could also um, affect the guarantee a little bit. Is that still true in these contracts?
Yes, it is. And carriers will give you a little bit of a grace, 2 or 3 weeks. I don't think anybody in the world's perfect where, if your premiums due March 1st, no clients can ever pay a premium March 1st every year. So they're going to give you a little bit of grace. But the one caveat, as you guys mentioned, with these no lapse riders is it is pretty strict on making sure that the premium you're going to pay for whatever you set the duration of those premiums up originally, it's important that you pay it relatively on time every year. I'm a big fan of EFTs and whether it be monthly or annual carriers. Bank draft's not just a monthly bank draft. You can pay an annual bank draft all day, every year. I'm a big fan of that, especially in the no lapse guarantee space, because again, as I talked earlier, life happens, things happen. You have a premium due every year on March 1st, and all of a sudden, you're going on the family cruise, and it's February 15th, and you're not going to get home, and it's one of these things you forgot about. So getting, the more automated or somewhat automated you can get these contracts, the better for ultimately long-term success. And that's where it just goes to servicing things too. If you got an advisor that sold you something 10 years ago and you've never talked to them, chances are that client versus a client that has an advisor that's meeting with them every year, you can kind of see you're going down two different paths. Who's going to have the most chance for success in making sure that we're funding the policy and paying premiums when we want to, ultimately, to make sure that policy continues to serve the purpose that we wanted to when we put it in force.
So, Matt, I think as you kind of started this conversation, you were talking about the difference of with whole life, usually the goal is that put as much cash in to have not as much death benefit. The focus is not the volume of the death benefit as much. Whereas when you're looking at this tool specifically for estate planning and being able to pay estate tax, the objective is usually to put in as low of premium as possible for the highest death benefit.
Mm-hmm.
Can you talk about within these guaranteed or the IUL products with the guaranteed, the no lapse guaranteed riders on them? What is the difference? I mean, maybe not in dollar amount, but maybe the ratio of premium to death benefit that you see on the whole life versus premium to death benefit on these IUL products with the guarantees or the guaranteed products.
So I'll say one thing, not to counter what you said, but obviously, as for what you guys have talked a lot about on these podcast videos, whole life you guys use for that. You can use whole life for the same thing we're talking about here. It works differently. You're just using different products depending upon the carrier that you're working with and all that. So whole life can work in this space as well. If you were comparing a whole life with kind of more of a death benefit oriented contract compared to a GIUL or a GUL like we're talking today, typically you're going to have, I'd say, maybe not double, but maybe close to double the amount of coverage that you get out of the gate with a whole life contract. So if someone was paying, and I'm just going to spitball numbers here, so don't take my word for it, but if someone was putting in $20,000 for $1 million death benefit in a GUL or GIUL, that whole life contract may start out at, say, $500,000. But obviously, one of the features of whole life is dividends come in. As dividends come in, you get paid up addition riders, and that $500,000 death benefit with whole life will continue to grow and grow and grow over time. So our product or the products we're talking about today, the GULs or GIULs, that $1 million is going to stay level, and it's going to be what you bought today, $1 million, that's what's going to be forever. Whole life ultimately steps up, and eventually you're going to have a crossover point where if you kind of treated the policies apples to apples and the same out of pocket contributions for the same durations, usually the whole life products will catch up death benefit wise when you're kind of, I'm going to say, age somewhere between 88 and 95 is typically what we see. And so, yeah, I think the biggest thing of a death benefit oriented contract versus in a GUL versus a whole life is you're getting there day one. So we talk a lot about insurance and why you utilize insurance policies. And a lot of it's, you're buying yourself time with whether you do Roth conversion plannings and you're trying to build wealth tax free for the family in a Roth conversion, or I'm using a GIUL. The biggest difference there is you're buying yourself time. You got to have time for that whole life or that Roth conversion to work. Whereas these GULs, they're basically getting you there day one.
And so would the benefit of that be that if you died tomorrow, it would be more advantageous? Whereas if you died when you were 100 years old, maybe the whole life would have been more advantageous.
Correct.
Go ahead, Bruce.
It's fun. It's funny when you say die tomorrow, it's more advantageous. It's a greater internal rate of return if you die
it's
earlier.
Financially a better rate of return.
Yeah.
I mean, that's how it is with term insurance too. I mean, if you paid a little tiny premium and you died the next day, financially it's amazing rate of return. Life-wise, it's the most terrible thing that could happen. I mean, I'm not saying that you want that rate of return. I would never bet on that rate of return, but financially speaking, if you did die earlier, the IUL or the GUL product would have been better.
And I think, today we're talking a lot about high net worth and estate tax planning. And I think that's where, it kind of goes back to what are you doing estate tax planning for? Well, the goal is to cover an estate tax exposure that my estate may have, whether that be in the next 2 years, 3 years, 5 years, 10 years, whenever it is down the road. So the benefit of these products really fits that world very well because, again, we don't know what life is going to happen and what life is going to bring to anybody. So if you do have that estate tax exposure or that potential estate tax exposure, if legislation and things change in the future, with these products, you have a known that, whether I live to 100 or I live to 80, I'm kind of based on the planning and what we're getting into, I'm covering that risk. I'm mitigating that risk. You don't necessarily want to, gamble's not the right word, but you don't want to, I would say, hey, for this risk to be fully mitigated or fully covered, and make sure that, hey, I got to live to 95 for this risk to be covered. So I think the big benefit there is you're planning for more knowns and certainties of risks that you're trying to mitigate. And that's what these products would do a great job of accomplishing.
All right, Bruce, go ahead.
And I want to follow up on one thing that Matt talked about. This conversation is great for high net worth people for the estate tax exemption. But what is the definition of high net worth? I always find this very interesting when a client says, "Oh, I have a decent amount of money, but it's really not that much." And you go through their financial picture, and all of a sudden it's like $6 or $7, $8 million, and they don't think that's that much. Well, that's because they don't realize what the average is across the United States, and that's well above the average. And it's kind of like nobody ever thinks they're wealthy. The guy next door is wealthy, but they're not wealthy. So I think the thing when I'm always trying to
Bruce,
talk to
here's
a person,
what Google says, which I can refer this. I mean, it's probably most people who think they're not very high net worth. So high net worth would be 1 million or more of investable assets. Very high net worth, 5 million or more. Ultra high net worth, 30 million or more. So yeah. I'm sure that Google's not God, but
but they're doing an accredited investor and then a sophisticated investor and then a high net worth investor. Those are consistent with the industry standards that they talk about. So I think that's pretty accurate. But my point is that the lack of liquidity is something that you have to look at all the time. And that's what Matt was talking about as far as, you have to know your client, you have to know what their needs are. So that you can give some peace of mind in the future. So in my career, when I've always looked at universal life is people look at what they think they're going to do, but they don't actually carry through with what they're going to do, whether they're getting follow-ups or not, because I follow up a lot and people still don't do what they say they're going to do, even if you follow up.
Because we're
And
human.
yeah, yeah. And the fact of the matter is that certain products, you got to be careful with certain people's habits. So example, we're working with a person in California right now whose brother doesn't have any heirs except for his brother, and his brother's worth about $60 million, and so he wants to pass it on down to the next generation. Interestingly enough, the brother, even though he's worth $60 million and he doesn't have any heirs except for his own brother, he's not even worried about mitigating the taxes or trying to do some life insurance because he's been a stock market person his entire life, and he thinks that life insurance is silly. I mean, he just doesn't understand it. His brother, on the other hand, does understand it, and he's like, I want guarantees. So we actually did some whole life, and we actually designed it for the future, but it's got more flexibility, even though he may take loans against it. Now, that's the big problem with guaranteed universal life or universal life, with Matt already talked about, is you start messing with the contract by taking loans and not repaying them, then all of a sudden the objective doesn't work anymore. With whole life, or even with the guaranteed universal life or index universal life, if you have the ability to take the loans and pay them back, well, this particular person, is doing about 200,000 a year into a whole life policy, but he's also sitting on about $12 million of liquid, so that if he does take a loan, I know he can pay it back. And we've had this conversation over and over and over. So even if he doesn't carry through, at least I know I had the conversation with him. So when we're talking with clients, it's not just about the estate taxes, like Matt mentioned. It's also about the best way to, because you think, oh, I'm never going to have a estate tax problem. The best way to actually transfer wealth the most tax efficient way, and that would be in a life insurance death benefit. So we talk with a person that has 5, 6, 7, 8, $9 million, but they only live on 120, $130,000 a year. Well, they're going to have a lot of their assets are just sitting there doing nothing to get passed to the next generation. And if that's in a tax deferred situation, they're going to, now with the current tax law, the Secure Act 2.0, they're going to be passing a high they're going to be passing a high tax liability onto the next generation in a very short period of time. So Roth conversions, a lot of people say, well, I can Roth convert, but now it's still a Roth. So the person, even though they won't have any tax liability, they will have to empty the bucket. Why? Because Congress wants to get the money out of the bucket and put it into a taxable place, such as a brokerage account, or maybe even do some tax deferring with an IRA contribution for yourself. So they're trying to re-establish tax in the Roth conversion.
So Bruce, I don't know the answer to this. So are you saying there's still RMDs within a Roth? Is that what you're saying?
Yes, under current tax law.
Sure.
So when
okay.
that gets,
so that's a required minimum distribution. And what Bruce is saying is that even if you've handled the tax situation, you still have to pull the money out of your Roth at some frequency, which is required by current tax law.
Yeah, over a 10-year period, and then what are you going to do with it? Well, you're going to place it somewhere. Well, you can place it in a brokerage account, you can place it in your bank, you can place it in another tax deferred, which is all creating future taxes. Or you can do a Roth conversion, but not actually go into a Roth. In other words, pay the taxes now efficiently as possible and take that distribution now and place it into a life insurance product. And now when that gets passed on to the next generation, there is no required minimum distribution, whether it's a taxable required minimum distribution or a non-taxable required distribution. So that, what I'm trying to wrap this show up and say, it's not just for estate taxes. It's actually the best way to pass assets on to the next generation so that they don't incur a tax situation.
Which is profound. I mean, especially if you're looking at multi-generational wealth, because you are paying your life insurance premiums after tax. You've already paid tax on the seed. You don't pay tax as you are. I don't know how this works in a universal product, so if it's different, please correct me. But with a whole life product, if you are taking a policy loan, you are not paying tax on that loan. If you do withdraw from the policy above your cost basis, then you pay tax on that. But what is happening then is the death benefit pays to your heirs income tax free, and you're in a position where you are not having to have a taxable event at the distribution, as Bruce is talking about. Is there any changes with a universal product that okay, just
No,
wanted to.
I'd
Oh,
say
the only thing go ahead, Matt.
I was gonna say it for the most part is going to be exactly as you stated. And I think that this will be a whole nother conversation for you guys. But as Bruce, you were talking, and Rachel, you've mentioned a few times, I think one thing that keeps coming to my mind is there's never a one size silver bullet that's going to take care and be the end all be all answer for everything. You know, what we're talking about today, this is a part of an overall, whether it be an estate planning strategy, estate planning or legacy planning strategy, wealth transfer strategy. This is a piece to the puzzle. There's a lot of puzzle pieces that you want to get working together to ultimately accomplish the results that you want. And one of the big things that Bruce, you were kind of talking about earlier is ultimately legislative risk. It's a term that we're using a lot in the last couple of years, but it's something that I don't think a lot of people consider. A lot of people consider tax risk, and they think of tax risk as, hey, what's the risk that my income tax bracket may change? Or what are the risks that the estate planning exemptions and the estate tax rates may change? But there's a lot of other legislative risk that's out there that I don't think people consider or take into consideration. And ultimately it's just what's the risk that some of the legislation and some of these laws and rules may change. Social Security is to me like the prime example of legislative risk. You know, when Social Security first became a thing, it was a promised benefit to be a tax-free benefit to retirees once they hit the ages and all that. And obviously, as time has gone on and what we know today, Social Security is not tax-free for everybody. You know, there's different income thresholds that if you hit or you make too much money other income sources, your Social Security obviously has some sort of taxation to it. But back when it was rolled out, it was promised as a tax-free benefit. So we're continuing to see legislation and things change. And ultimately, how do we, you know, kind of what I always say is plan for the worst, hope for the best. We don't know, you know, we've seen the Secure Act 2.0, wealth transfer from IRAs, Roths have gone from a lifetime stretch down to a 10-year stretch. We don't know if that's going to stay at 10 years forever. We don't know if it's going to go to 5 years, if it's going to be a forced, you know, as soon as you pass on, you got to recognize that. So it's just kind of, as I mentioned earlier, it's about how do we diversify and put together a congruent wealth transfer plan that takes, I think, a little bit of everything into consideration, because this is never going to be the silver bullet that's going to accomplish what we want by just doing this. It's got to be matched and married to everything else in the comprehensive financial plan, and ultimately having all those work together, which is advisors like Bruce and him all around the country. That's why it's so important to have an advisor that's not just laser focused on whether it be a GUL or whole life or IUL or any other financial product. You got to have independent advisors that really can do a little bit of everything for you and ultimately make sure that everything that they are doing for you works together. It's like going to a doctor and saying, hey, you know, I need to get XYZ surgery, and that doctor's going to say, well, I don't want to look at anything else in your surgical history. You came to me for this. This is what I'm going to do. Obviously, a physician would never do that. They're going to want to know what medications you're on, what your health history is, what your surgical history is. They want to know everything else so they can make sure what they're going to do is ultimately not going to hurt you or have any negative ramifications. And the exact same thing goes to financial planning. And specifically today, talking about kind of the wealth transfer estate tax stuff, it's got to complement and marry everything else that's going on in your plan.
So, Matt, I think you just answered what my final question was going to be, but maybe you have something that you might add to this. So, in the world of somebody who says, really, I do want both. I want to be able to have a powerful tool to store cash that I can access and use. I want that wealth accumulation or that banking capability. And I want to be able to minimize estate taxes when I pass away and that estate transfers to my children or my grandchildren. and I really do want the benefits of a banking policy with the guarantees built in, but I think I'm going to live a long time. I hope to live a long time, but I'm going to have some concerns with estate tax, or I could have concerns with estate tax. And how do I handle all of that? And I know there's not one silver bullet, but what do you say to that? Would you more specifically design a product to do everything, or would you have multiple products to do different jobs?
More than likely, we're going to do multiple products to serve different purposes. I mean, we get the question a lot, from advisors all around the country of, hey, we want to do this, we want to accomplish this, and this, and in the end, you end up getting a watered down product because you're trying to have it serve every single potential thing that you want it for, and you're going to be far better off saying, hey, here's the chunk of money that I want to get working for me and kind of get that whole life or whatever product you're using to kind of have that asset class type product. And then ultimately over here, if we're trying to cover a completely separate objective, then we want to utilize ultimately a different contract for that. Doesn't mean that as time goes on, 10, 15, 20 years down the road, that whole life contract, maybe you purchased with the intent to use it for the things like Bruce and you guys talk about all the time. Doesn't mean that if time changes or needs change in the future that you may not redeploy and restructure that contract, maybe put it into an ILA or an irrevocable trust of some sort, and make changes to it. But for the time being, I'm never a fan of trying to have the end all be all jack of all trades product that can give me cash accumulation, give me estate tax free DB, give me long term care, and really serve anything and everything that people often think of. Insurance will cover it. Compartmentalize it, get different products working, and use that to your advantage. It's just like an investment strategy. You're not going to get into an investment and put it into one investment and hope that it serves. Give me downside protection with upside potential and have this one investment take care of everything. You diversify that. So this is kind of the same diversification, just utilizing different products for different things based on the financial plan.
Excellent. Well, thank you for just all that wisdom that you've shared, all of just your experience and your knowledge of the products. Bruce, I know we're really close to the end of our time here. Is there anything else that we have missed that you feel is really important that we need to bring into the conversation?
Yeah, well, I don't think we have time for this, but the only other thing, Matt, could you talk about MECing policies in the universal life for the purposes of estate tax planning, just real quickly?
Yeah.
Is that something that
there are certain products and certain solutions out there that creating a MEC isn't a bad thing. A modified endowment contract, I think, sometimes has a little bit of a black box in our industry that it's a complete no-go. And again, it kind of what we talked about earlier. What is the goal? What are we trying to accomplish with this chunk of money or asset class? MEC contracts aren't necessarily a bad thing. Death benefit still pays tax-free. If you have chronic illness or long-term care riders, those still will pay out tax-free. So again, it just kind of goes back to what are we trying to accomplish? What are the goals of the product, the policy, and how we're funding it? And it a lot of times can make sense, especially in the healthcare, long-term care space. A lot of MEC contracts are out there. But there's a ton of products that, again, depending upon what the client wants. If it's just, hey, I want to throw a chunk of $100,000 at something and have access to it 5 years from now. There's great products out there that are for that. But again, your trade-off, you want that high liquidity, ROPs, asset-based care, whatever it is, there's a trade-off. You can't have that product serve all these other things that we're talking about. So in the right scenario, there's a lot of great solutions out there that are modified endowment contracts. But again, you just got to kind of figure out what are we trying to accomplish.
Okay. One last question. We've talked a lot about these guaranteed IUL products and where they do shine. Is there any place where you would not recommend them and you would not choose to use them in the world of estate planning or outside?
Yeah, I think I want access to my money. I want to be able to take distributions from this policy and redeploy it for other opportunities that I might have in my financial plan. I don't think any way possible you'd ever want to probably utilize a product that we're talking through today to ultimately have it serve that purpose. I think that's the big trade-off is just, we've said this a few times, not to beat a dead horse, but what's our goal? What are we trying to accomplish? And if we know our goal is ultimately hitting a certain number to help cover an income tax hit or an estate tax hit that our estate may have, these products will fit well. But if there's the inclination that the client may want some flexibility, some access to cash, some access to capital, then we're probably going to go in a different product that, again, maybe dilute it down a little bit, but by diluting the death benefit down or getting less coverage, it may give you a little bit more upside in your cash and you may have access for it. So to me, access to the internal cash accumulation for potential future distributions and access is probably really the line in the sand where it's like, if that is going to be a concern or a need, we probably want to avoid these products.
This has been really, really helpful. And did you want to, Bruce, ask a question about how to have advisors who might be interested in connecting with Advisors Excel connect with you? Bruce, is there any other way that you would frame that or have?
Yeah, Matt, I mentioned this last week. We have a lot of agents that listen to our podcast because they reach out to us all the time. If they would like to get more information about Advisors Excel and what you have to offer, how would they reach out to, and who would they reach out to?
Yeah, I would say for sake of this conversation today, have them reach out to myself. My email, matt.ewald@advisorsexcel.com, matt.ewald@advisorsexcel.com. You can go to our website, advisorsexcel.com. Again, it gives you a great little landing page and kind of talks a little bit about everything that we do. I think there's also even a section on there that you can click in and say, I'm an advisor and I'm interested in hearing more. And one of our teammates that kind of specializes in talking to all the things that we do can help you out. But if you reach out to me, I can get you to the right team. That the annuity side at AE is kind of our, call it, recruiting team, and they're the ones that really talk more high level about anything and everything that we do. I work with a lot of great guys and gals over there. But worst case, if you reach out to me or call into AE, our number is 866-363-9595. We can get you to the right people and talk through and navigate what is your business like. I think the one thing I'll say is, we're never going to be a one size fits all strategy. We built this company working with the right people. Just like you as financial advisors, Bruce, there's clients that are great fits and there's clients that are not great fits. And the ones that aren't great fits, the farther you kind of lead them along and down those paths, ultimately you end up spending a lot of people's time. And so we have a fit of what we're looking for, independent advisors out there that are kind of focused on that retiree space. But yeah, we'd love to everybody out there, have a conversation with you. Get to know a little bit about your business, what's going on, and ultimately talk through how we can help, where we specialize, and see if there's a potential good fit there.
Excellent. Well, Matt, thank you so much for sharing your wisdom, your knowledge, your expertise today, and just helping us to unpack and understand the context of different types of products and what the specific design and use and functionality is, so that if somebody is listening and they're in a space of saying, I do have specific goals for estate planning, or I need to minimize and mitigate estate tax, or I do want that cash accumulation, or I'm in a position of needing to use the capital and wanting to have a place to store capital, this is a conversation where they can really understand the various products available to them within that space to use life insurance, which is a powerful tool for your life and your legacy.
Yeah.
Awesome. Well, thank you so much, Matt, for being here.
Me. It was a pleasure, and we'll be in touch, Bruce. Nice to meet you, Rachel. Look forward to seeing you guys in the future.
Awesome. Sounds great. Thank you, Matt. And if you're listening today, please remember, success leaves clues. So model the successful few, not the crowd, and build a life